Welcome to The Finance Geeks, a podcast about real financial planning. Join us as we get into the nitty-gritty, discussing everything from pensions to portfolios. If you're into numbers, strategies, and running a successful practice, this is your ultimate geeky hangout.
Hello and welcome to Season 2, Episode 12 of the Finance Geeks podcast. Thanks for joining us. My name is Warren Shute and I'm joined by...
Paul Cleworth.
Hi, Paul. And today we're talking about our tax year-end planning process and ideas and strategies and all good stuff like that. But before we dive into that, Paul, tell me what you've been up to.
I've been enjoying the outdoors, Warren. We've had a bit of nice weather recently, albeit it's been a bit chilly. But I've been out playing golf.
Nice.
I played with Kevin, my power planner, on Friday. We played in Redbourne, played quite well. The ground was under repair, and so they gave us a discount. Gave him a discount because he actually paid for it, which was nice. And there was sand all over the greens, and so we should have shot maybe 91 or 92, but we shot 95, and we drew in the end.
Drew.
Having not played,
bonus time coming up.
I didn't want to beat him, did I? And make him feel bad and ruin his self-esteem. So we both actually played really well. And on the last hole, we were neck and neck, and then he had the opportunity to win for a putt, but just missed it, botched it up. Anyway, enjoying the golf. I had a sore back afterwards because I've not played for over a year.
Yeah.
And people say, "Oh, what do you like to do?" And I like to play golf, and that's not that. My track record doesn't reflect that recently, so I'm going to play more golf coming up. Anyway, I've been out walking the dog. I've been out on scooters and bikes with my young sons. My youngest, Rory, who's coming up for 10, he's very into the electric scooter we've got now. So he has got the bike, I've got the scooter, and then we swap. And so we go around Fairlands Valley Park, which is in Stevenage, and he absolutely loves it. He's got to grips with it. It goes 25 miles an hour in level 3, but he just sticks to level 1, which is about 7 or 8 miles an hour. What else? Last year, I've been doing a parents' evening for my eldest son, Miles, who's 13, and it's all online these days, as you may know. But the first, and he did really well actually, so I'm very proud of him. But the first meeting online was at 4:05. The last one was at 7:45.
Oh.
So I'm there hanging about, and he had about 7 or 8 different teachers. Each one's 5 minutes, and you end up starting a bit late if you like because you have to click the appointment button. And then as soon as it finishes, 5 minutes counts down. They just go, even if you're mid-conversation.
Yeah.
So
Yeah.
it was a long evening, to be honest, but at least we got to do it from our kitchen.
That's cool.
So that's me. What have you been up to?
Again, playing a bit of golf, which is nice. So enjoying as much of this good weather as we can. It's still a bit chilly out there, but and I've got to be honest, my golf game has really gone down over the winter. So I need to put a bit of effort in because I've got the CSI game up in Glen Eagles coming up. So any financial planners listening, you fancy a game up in Glen Eagles? The CSI Scotland have got a tournament going up there. I think that's the end of May. And I've got a few other games. We've got a game booked in, so I can't have you beating me. It's got to retain my trophy. It's but yeah.
Are you warming up? Are you warming up before you play, or are you just turning up and teeing off?
No, warming up a bit. Warming up. Yeah, I am warming up. I just don't know. It just, so I thought myself a hack motion. I don't know if you've come across those, hack motion.
No.
I went on ChatGPT and said, like, how can I improve my game of golf? What things have you got? So I got myself some...
what did it say? Give up.
Give up.
Try bowls instead, indoor bowling.
Sorry, Warren, you have no chance, no hope of improving your game. Just give up. I feel like it sometimes. I'm like, really? And then you hit a great shot and you're like, well, I'm doing everything the same. So, I need to get out a bit more. I bought myself...
muscle memory. Golf's about muscle memory. Practice.
Yeah, I've got all the gadgets now. I just now need to use them. So, doing that.
You got a golf watch?
No, I use the Apple Watch. I've got Golf Shot on there, and I use that to track all my scores and things. So it's pretty accurate, actually.
That's a quote from Tin Cup. Yeah, good. Best golfing movie. I'm not sure there's any more. Can you name any decent golfing movies besides that?
No.
Legend of Bag of Ants?
No. I watched a really good golf movie. What was it called? It was about Mexican boys. I'll remember it and I'll let you know. It's actually a really good movie. Nikki and Bella watched it in the States when I was over there. We went, Nikki and Ollie. Bella and I went to a country concert, and they really recommended it. I watched it when I got back. It's very, very good. It's about the schools in America, they were pretty much segregated, and how the Mexican lads were playing particularly well and beating the American lads.
You seen Caddyshack or Happy
Yeah,
Gilmore?
yeah. See both those. Yeah, they're good. Yeah, I'm making a note because I might watch them again. That might get you back into the game. There was the film as well about the guy who entered one of the opens just because you can, but he wasn't a pro.
Yeah, Tin Cup.
Is that Tin Cup? Is it?
Yes, with
Yeah,
Kevin Costner.
that was a good film. Yeah, I enjoyed that one. Yeah, that's very, very good. Very good. So we've been doing that. And then Saturday just gone was Ollie, my son's 20th birthday. Goodness me. 20th birthday. And yeah, we spent the day, I was explaining earlier, in Bath doing the half marathon. He wanted to run a half marathon.
He spent his birthday doing a half marathon.
I know. I tried to talk.
Has he got the fitness bug or what?
Yeah, he's just a young lad. He's really, really likes Chris Williamson. He's really sort of driven. And so I wanted to sort of calm down a bit and just enjoy life and things. But hey, he does enjoy life. He loves fitness, and he's enjoying what he's doing. So just different, I think, just different generation. Hey, I'd be complaining if he was out on the lash every weekend and not working and stuff like that. So he works hard.
Point taken. No, I agree. That's fantastic.
Works hard, trains hard, and he loves life. So I just wish I was as mature as him at his age. I guess that's the key thing. So
very good.
So main focal point of the show today, we're going to be talking about tax year end planning and what we do with our clients. Where do you want to start off?
Well, at the point of recording this, it's the 18th of March. It's prior to the budget coming up, the spring statement on the 26th of March. There's been, lots of speculation in the press, which I'm going to ignore because we don't know what it's going to be until it is. But what you can do and what your clients can do is take action before the end of the tax year, which really means before the end of the month rather than right up until the 5th of April if you're going to use certain providers because they get busy. But we've communicated with clients sending our end of year tax guide. We've encouraged them to take action. We're quite busy at the moment processing a lot of that, doing sweeps from general accounts to ISAs, topping up ISAs, topping up pensions. And I think that our listeners, whether they're financial planners or clients that are listening or non-advisors, you can get a lot of this information very, very easily online. And I think that what I'd like us to talk about is some of the more specialized things that we perhaps do, some of the ways that we encourage our clients to take action, and some of the habits that they can form over time, and to get them to understand, why it's important.
Yeah. I think for us, we include that in our Lexington Times, which we send out every month, which is part of Andy Hart's Hum newsletter that we use, which we really, really enjoy. But we kind of target it on clients who are sort of almost marginal. So those that are sort of additional rate taxpayers or just into additional rate, higher rate, those who lose just over £100,000 of total income, losing their personal allowance. Those who might be affected by the child benefit, so things like that. So where there's sort of marginal things, where the pension contribution can really be an added gain, I think, for pension contributions such like we like to try and sort of target that. But if I'm honest, we're doing this throughout the year, so we don't tend to do an awful lot more at tax year end because our sort of, we announce it and we let people know, but our kind of thought process is, let's do this as we go through rather than leaving everything till the end of the year.
Yeah. I think there's a perception, isn't there, that, and I just said earlier on, these figures are available and, you can Google the allowances, but what's more important is speaking to the advisor to help the individual take action to actually, and looking at their individual circumstances, as you mentioned, depending on the level of income. If it is in that between 100 and 125,000 figure, you can save 60% income tax by making essentially a 20 grand contribution, getting £5 uplift at source, and then getting another £10,000 back in your tax return. But you see that what I found is there's assumptions. There's a lot of people have assumptions about how things work, and they're often the wrong assumption. So, for example, when you're getting if you're a higher rate or an additional rate taxpayer and you need to submit a tax return to get your marginal rate back, there's a couple of things you can do. One, you can write to your local inspector for taxes, or you can actually do a return. And the weird thing is that there are people now on incomes that are high incomes over 100,000 where the revenue are writing to them now and saying you don't need to do a return, which is unbelievable because it used to be the case that you had to do one. And the thing is, the individual that takes that advice and says, "Oh, I'm PAYE, I won't do a return," they might not be claiming any higher rate or additional rate tax back that they're due.
Yeah.
So there's also this perception I've noticed in the past where people might think that you get higher rate tax relief on, let's say, a 30 grand contribution if you earn 50,000, 52,000 pounds. I'm like, well, you only get higher rate tax on the amount that's in the higher rate tax band.
Yeah.
And when I said before about getting higher rate tax relief back, I generally said to my clients, rather than just let it inflate your tax code, if it's over £1,500 or 2 grand that you're owed back, ask the revenue to pay you that money back as a lump sum,
Yeah.
and keep your tax code the same.
I think we're talking about pensions here, which is 100% accurate, but also bear in mind it also the same for charitable contributions. We have a lot of clients who make decent charity donations and things, so we want to make sure that they are both making those in a timely manner, so they're making them now before or after the tax year end because they get the tax free sooner, and also they're claiming the additional and the higher rate tax release on those. I'm trying to think of CAF Charity Aid Foundation, the bank. We've got a couple of clients who've got accounts with them, so they can just pay the money into that account, get the tax relief on their contributions, then wait and distribute it to charities at their leisure at a future date. So that's quite handy.
Gift aid is often missed off tax returns, and clients forget to put that on. And another thing that's perhaps not fully known, if you want to do your tax return early really means around about late May or June.
Yeah, before October, I think, isn't it? You can do the paper one.
Yeah, before October. But if you do it, the earliest you can realistically do a tax return to claim that relief is probably end of May, early June, because you have to wait at least a month after the end of tax year to get the information from the provider, usually, and download the information. And then if you submit information to the tax office too soon and you pay your tax bill too early, sometimes they send it to you back. They say, oh, you've paid it too early. And if you pay it around October, you'll get an actual return, you'll get interest on your tax payment, which is great. I think it's like 3.5% or 4%. It's quite generous that the revenue give you if you pay, whether it's your income tax bill or your corporation tax bill for a business, you've paid early, you get a bit of interest on it.
So I was just going to jump in. We've talked about pensions. You mentioned ISAs and stuff. Another big one for us is lifetime ISAs. Really trying to encourage the children of our clients. We really want to engage the family as a whole. So trying to engage the children of the clients to fund their lifetime ISAs. And my Ollie's been doing it for a number of years, but Bella was 18 in March. So she'll have a lifetime ISA set up this year, put the full 4,000 in, and then we'll top it up next year as well.
Yeah. It's obviously part of that £20,000 allowance, and the children that are young enough to be able to do it, to fill that part of the ISA, the LISA element, and the rest of the ISA if they're able to as well, with contributions from parents or savings that they might have. So, the habit of trying to, if you've got the assets to fill ISAs, junior ISAs, pensions, if you can do all of these things and you do it consistently each year, as much as is possible, or rather than just try and top everything up in March, do regular premiums. I think I generally do recommend sizable regular contributions for clients into ISAs, pensions throughout the year, and you get into that habit of paying it regularly. And then maybe you could just top it up at the end of the year, just if you've got surplus monies. It's easy to assume that everybody's just got £60,000 to pay into a pension, or 48,000 net, if you like, to max out your pension allowance, and 20,000 for each yourself and your wife and your and your kids. Not everybody's a millionaire to be able to do that.
No.
But these little tweaks can make a big difference over time. Like the other thing that we've been doing a lot of is using the £3 grand CGT allowance and factoring in losses from previous years, and make sure that clients of ours are using everything from marriage allowance to their dividend allowance to their personal allowance if they're not using it. Because if you don't use these things, they get lost.
Yeah, they do.
And it's, again, this all comes down to the habit and the knowledge and somebody nudging you along to say, look, you should really do these things. It's a perception that an accountant saves you a lot of tax, and they can. But I think an advisor, one of the best things a good financial planner and an IFA can do is to tangibly save a client a lot of tax.
Yeah, no, 100%, definitely. And, going on the capital gains tax side of things, I think at the moment people are sort of concerned about the markets, the markets pull back and stuff. It's a great opportunity to realize losses. If you've got losses, to realize those, carrying them forward. But also, if you're thinking of donating to a charity and you've got capital gains, well, donate the asset to the charity as opposed to cash. Best thing you can do is donate a capital appreciated asset to a charity, no capital gains realization. The charity gets the payment, they sell it, no gain, and you keep the cash. So, There's so much that a good financial planner can do for your client, and this is why regular, typically annually planning meetings bring these thoughts to fruition. A couple of things on companies and things I wanted to sort of touch on as well. A lot of, everyone probably is aware listening, you have your company year end anytime you want, but so many companies we come across run it with the financial year. So if your company is coming up, make sure you're doing everything you can to get those costs in early, so that you're going to get the breaks early, rather than just waiting another sort of 12 months. You wait until the new tax year, you're not really going to see the benefit of that for another whole year.
Effectively 21 months. The most common end of tax year is the 31st of March. After that, the 31st of December. If you're running a business and you're very, very aware of your P&L, your position, your balance sheet, and you use software like Xero or Sage or whatever you use, or QuickBooks, for example, if you're on top of where you are in terms of your total revenue and costs and expenses for the year, and you know what your retained earnings are, you can plan out prior to the end of the tax year the optimal level of salary, drawing dividends to certain allowances, whether it's higher rate tax up to 100,000 or more, making use of your pension contribution, which is sort of in line. I mean, it's not quite the exact tax year, the 6th to the 5th of April, but it still works. So if you're going to make an employer contribution to your pension, you get the expense in prior to the end of your company year, and you also make use of your annual allowance as well. And I think a top tip as well, business owners, they often just think, oh, gross employer pension payment. You can actually make personal contributions as well. And when a typical business owner, small business typically, will have a salary of 12,570, personal allowance. Some of my clients, I've encouraged them, if they've got surplus cash personally, to pay £10,000 in, which grosses up to 12 and a half, 10,056 to gross up to 12,570, which will extend the basic rate tax band and essentially give them 20% at source, but it'll give them that reduction in the highest rate of their dividend allowance as well, of their dividend tax. So if they're paying anywhere up to 38, 39%, 39.35 in additional rate tax on their dividends, they're saving a considerable amount of getting so much tax relief because they're paying less tax on those higher rate or additional rate divs.
Yeah, you mentioned sort of Xero in QuickBooks and Sage and stuff. It is so important, because if you've got an idea of what your profits are going to be, and if your tax year end's coming up and you're going to be over the £50,000 and such, like going into the marginal corporation tax rate, there's things that you can do now. The planners listening are going to know what they are, to bring yourself down to save that additional tax at the higher rate. So it's a prime time. And I think, it basically falls down to, being financially well organized and taking consistent professional advice, ongoing advice. And, I think this is the great work financial planners do.
There's a lot of individuals that don't quite know what their total level of income is, and it's hard to get it exactly right until after the tax year. And then it's too late to make a pension contribution for the previous year. Obviously, you can use carry forward, but you've got to use the current year first before you go back. I think that for business owners, it's the same as being an individual when it comes to tax. If you're running a business, if you're self-employed, if you've got a tax bill to pay, the ideal scenario, in my view, is to sort of try to estimate as best you can what your tax bill is going to be for the whole year, whether it's corporation tax for your business or personal tax bill on rental profits, whatever, and save that money monthly into a tax saving account, into a separate account. It's tricky sometimes, but the ones that come a cropper is when you're running a business and then all of a sudden you have a really good year, you pay yourself more in terms of salary and dividends. You've then got an unexpectedly massive tax bill because you've got the tax balancing payment and then 50% money on account, and they've not saved the right money into tax every month. Yeah. And I noticed that a lot of accountants don't, in my opinion, encourage their clients to say, well, tell me how much you want to pay yourself this year. Let's work out what that could be, and let's work out how much the tax bill is going to be, so you can save every month into a tax account.
Yeah, and I think if there are any accountants listening, I think that's a really good value-added service that you can do for your clients, is just calculate their tax, regularly, monthly, so they can put it aside. I know it's stuff that we've done for clients ourselves because the accountants haven't picked it up.
There's a couple of things I wanted to move on to, and when we're talking about tax and saving, and before we get on to the sort of importance of consistency and strategy and the mindset of saving tax, I actually have got some stats for you, Warren.
Oh, you surprised me, Paul. Go ahead.
On tax, And I don't know why I've been paying more and more attention to it, but I am still quite amazed. I think it's always in the back of the advisor's mind when it's in the press constantly about the high taxation we pay in the UK, and where does it all go? Where does all the money go? So here's some stats. These are from the 23-24 tax year, but in 23-24, the HMRC took in 843.4 billion in tax revenue, and the four biggest taxes are, Warren,
Income tax,
number one, yeah,
VAT,
yeah, that's third,
national insurance,
yeah,
uh,
and corporation tax, very good. So income tax and capital gains tax accounts for 286 billion, national insurance 172 billion, then VAT 161 billion, and then corp tax 85 billion. And all the other taxes, of which there are, 25, 30 or whatever, there's so many, about 139 billion. But what's interesting is they take in all this money, and yet the projected spend this year in government is 1.276 billion. Yeah, it's 1.276 trillion. So that's 1,276 billion. So it's considerably more than they're receiving. Look at the amount that they're projected to receive in the current year, and then look at what's called the budget deficit or the public sector net borrowing requirement. It's 127 billion. 127,000 million pounds is what we need to find, either by taxing the public more or big companies or billionaires more, or reducing spending. So the government are just issuing more, either going to have to issue more bonds, more gilts to generate that money, or tax more or spend less. It's literally one of those things. Have a guess what our national debt is at the moment in billions.
in billions. It's probably over 1 trillion, isn't it? I guess.
Yeah, it's 2.6 trillion, so 2,619 billion pounds, which is now, it used to be 100%. It's 97% debt to GDP ratio of the UK. So we generate goods and services, gross domestic product of around about 2.6 trillion pounds in a year, and that's how much we owe in bonds and borrowing. And
I guess
crazy the figures.
I guess I'm right in thinking it's about 100% of what you earn, right? It's like, you earn £100,000, like I earn £100,000.
Well, listen. In Germany, their debt to GDP ratio is like 60%. They have a much lower level of national debt in Germany, but places like France is higher than us, over 100%. Japan's higher than us. Italy, Greece is massively higher than us. And the UK, we've got this bizarre thing where we all think that we're being taxed too much, and I agree with that. But I'm a big fan of Gary's Economics. He's a YouTuber, an Oxford graduate, a trader from a poor background. He's on. I'll put a link to him in the show notes. But he keeps talking about how the poverty gap is getting bigger and bigger, and he's absolutely right. And during COVID and in the last 5 years plus, the amount of money is something like 800 billion has gone into. What did he say? It was 20,000 per adult, £20,000 per adult in the UK has been generated out of thin air with QE, quantitative easing. And yet, where's that money? Do you feel £20,000 richer? Where does it all go? And he's essentially saying that a lot of it's gone to the multi-billionaires. The rich are getting richer, the poor are getting poorer, and the standards of living are worsening in the UK.
I don't know if I agree with that. I think the richer individual, financially wealthier individual, pays more attention to their money and will notice it. But if you're an employee with a £200,000, £150,000 pension fund, you have benefited tremendously in the last 5 years from stock market appreciation.
It's all to do with what you mean by rich, though, doesn't it? Because you might think someone who's rich or someone who's well off or someone who's seriously wealthy is someone who earns or has assets of, let's say, 5 million or even 50 million. But what he's talking about is the ultra rich, the ultra high earning individuals, the people that are the billionaires. A lot of the money has gone to the super mega wealthy in terms of assets, in terms of product, in terms of, they're the ones that own all the assets. Anyway, I'm fascinated by it because I agree that the poverty gap is getting bigger and things have been more divisive, and you have to now earn more to keep up with the cost of inflation. The cost of, just since COVID, prices are up 35%. So Rachel Reeves can't just keep taxing us more. She's got to develop growth, initiate growth programs, and we need to, have a situation where we are generating more revenue as a country, and everybody is better off. I think it's anyway. That's me on my little my soapbox, about it. I'd like you to kick us off talking a bit about how you talk to your clients about sort of the mindset of tax planning, about consistency, about taking action with tax planning.
Yeah, I think if we're linking it back into the current climate of what's going on, what am I saying to my clients at the moment? We're really trying to get them to take advantage of this pullback, this breather in the market. Take advantage.
What would you say it is? Like a 6%, 7-8% reduction in markets from peak to now?
No, it's more than that. I think it's 10%. I think it's 2nd of February it peaked. I think it's down about 10% like that.
Right.
Market's back about 10%. But it's a breather. We're back to sort of September levels, just when Trump got inaugurated. Market. He's going in. So we've just got rid of all the hot air that Trump brought to the market. In my mind, that's really what it is. And when you kind of put it in that kind of perspective, the markets are still doing well. They've still grown very well. What I want my clients to do right now is, one, take advantage of any losses that they've incurred. So if we've got some capital losses, let's realize those. If we've got some capital gains that are now less than they were back in September, well, can we realize those? Can we realize those and start, reducing our capital gains tax liability? And also taking advantage of the whole market position where it is at the moment. So if you've got some cash on the sidelines, hey, definitely, my outlook on the market is still particularly buoyant and bullish. There's some great advancements being done with technology, and this time will pass. I think we have a focus sometimes, particularly for the more, and this is the beauty of age, and I never appreciated it so much when I was younger, but when you've been through these periods before, you have more certainty that this time is going to pass. This time's going to pass. Things are going to revert to the mean and things will get better. And what you want to do is really take advantage of the pullback in the market where things are at the moment. That's really the angle that I'm talking to clients at the moment. Our discussions around tax planning are pretty systematic throughout the year. If you're hitting those marginal rates, we want to make sure we try and get out of them. We put, maximum funding the pensions and ISAs and such like. But right at the moment, it's really around capital gains tax and taking advantage of the market. It's really trying to get in there.
We're acting, or I know that I've thought that we've had like a reduction in markets that's the same as the tech bubble in 2000, 2001, or the credit crunch, or the pandemic. It's nowhere near as severe as that. As you said, we've just had a pullback in markets, largely as a result of Donald Trump and his tariffs and what he's been doing in the Middle East with Zelensky and Putin. Whether he'll proceed to or whether he'll pull back through self-preservation and sort of a realization that everyone in America is going to be paying more and inflate the costs of goods and services will go up. I don't know. We'll find out. I don't know who his economic advisors are, but they're obviously lunatics, quite frankly, because there's no evidence to ever show in history that I know of that tariffs are beneficial for the country imposing those tariffs or global trade or anything. Going back to sort of tax saving and what our clients can do and how we talk to them about this time of year, I agree. I think that there's a discussion where if your clients have only been invested with you for a couple of years and it's been largely positive, and now there's a reduction in markets, it's a time to review the risk profile, perhaps just to reassure them it's not time for drastic action. I don't think that the majority of people should be in any way altering their risk profile if they've got 10 years plus or more before they need access to that money. Just leave it largely in global equities. I do know that our most popular portfolio is the 70-30 model. 70% equities, 30% bonds, and I think that's going to work quite well. We're sort of conflating what's going on in markets with tax planning, but the halfway house, if you like, is to do with CGT and gains, because you're right. If markets have fallen recently and clients can utilize that to their advantage prior to the end of tax year, that can work. So we've been moving some clients' monies from the general account into the ISA, doing sweeps. We've been selling down some to cash to fill and sweep for next tax year. We've been topping up pensions internally. I do try to encourage clients to put new cash in, and the habit of doing that and the consistency of what Nick Murray would always say is pay yourself first. Save for your financial future before you go and spend lots and lots of other monies. That is incredibly beneficial in the long term,
Yeah.
and it just brings in the whole concept of compounding and investment growth. It's I think saving for the future is a habit. And if you
Yeah.
get into the habit and you pay yourself first, that consistency beats perfection. You can't sort of look and source the perfect investment. What you can do is sort of find a strategy and stick to it. And the best strategy is one that you can stick to.
Yeah, 100%. Yeah, no, definitely. The great work we do is at times like this.
Oh, pat yourself on the back, Warren.
Yeah, no, seriously, it's true. And I think, if you're a financial advisor, financial planner listening, never underestimate the great work you do right now. Reassuring your clients, being there first. I did a video which I shared with you a little while ago, sent out to my clients just to say to them, hey, look, don't let politics interfere with your portfolio. Let's
Yeah.
keep the things separate. Let's keep invested. And I subsequently have just written a second blog post to them. We try and communicate to them before they get worried. My strategy for this is give them the information before they want to ask you for it. Preempt it. So just trying to give them, not bombarding it, but give it to them. During the pandemic, we had a newsletter system called Navigating the Corona Crisis, where literally every so many days I was sending out my ideas, my views of what's going on based on the information I'd got, in trying to cut through the noise. And that was very, very well received. And we try and do the same sort of thing right now.
I've actually reflected on my own values and the value that Tandem, my company, brings. And I used to think it's all about giving clients the knowledge, the facts, the figures. And actually now I've changed my mind a lot on this and thought replying back fairly quickly is a big USP of ours. Clients email, we tend to email back and get back to them very quickly. Helping them easily and clearly understand what the options are and to take action, hugely important. And I suppose reminding them and reassuring them that what they're doing is correct. Because you do get, very smart people that we both work with, and it's easy to Google something. It's easy to try and look for information. You can use AI and ChatGPT and all of these tools, but they're not always right.
No.
And especially when you Google something, you get so many results that you might think, oh, that's just correct. The benefit of, I think, an advisor looking through something to say, let me just apply my brain to this for a second. Let me think about it and let me try and give you what I consider is best advice. So it might be very, very bespoke for the client. They might not have enough cash, and you might say to them, okay, now is a good time to sell down to top up the cash. Or they might have not realized that they can make use of a certain allowance or top something up. And the turns of phrase that we have all the time. I'll give a client an example. For example, I'll give the clients an example such as if you pay £500 a month into an ISA for the next 20 years, and you get 6% a year return, you'll have a pot worth 231,000. And I'll send them the link from the calculator site and shows them the impact, the importance of compound growth, about consistency, about pound cost averaging, and that just starting it going is hugely important. And then talking to people about the importance of taking action as opposed to just doing nothing. It's really simple. When you think things are going well, to just do nothing and assume that someone in the background is doing it all for you. Like, I know there's a perception from some of my clients before I've educated them on this point, got a pension with I don't know, Legal and General through work. And there's an assumption that L&G are doing something for them in the background. I was like, they're not doing anything. You've chosen your funds. They're not buying, selling, managing, switching, rebalancing.
Yeah.
They're not doing any of that. They're not encouraging you to maybe change your pension to a salary sacrifice arrangement or a net pay arrangement through work, or top things up or make use of allowances or pay down debt. And so the more that we can give individual attention to our clients and help them make these decisions, the better off they'll be and the better job we're doing.
Yeah. So anything else you want to raise on that? Just like sort of summarize some of the key things. You have
No, I think that's most of it. I wanted to. We've got some quotes, obviously, for a bit later on, but we're. It's not a million miles off what we've said there. I think that people have got, by the time this goes out, a couple of weeks top things up to take action. I want people to know as well if they were about flexible ISAs. If you've got an ISA that's flexible, let's say the Transact ISA is flexible, the best time if you need to access that money is the 6th of April, quite frankly, because you've then got a year to put it back in. And by drawing on that money, it doesn't affect your £20,000 allowance for next year. So if you did need to top up cash, do it after the tax year if you need to draw any money out.
What we're trying to say is it's not necessarily about the changes in the allowances and the rates, etc. Clients can get that information anywhere, but what they're looking for is actionable advice, support. So, okay, I'm marginally into high rate tax. I'm marginally into additional rate tax. I'm just about to lose my child benefit. What can I do to do this? How can this pension contribution help me? How can this charitable payment help me? My company's going into the marginal rate corporation tax. I didn't realize that I could do this. Or I'm going to make these charitable donations out of cash, but I've got these investments that have got capital gains. I didn't realize I could transfer those to a charity, and that will save me the capital gains tax on that. So there's all these things. Really, is actionable advice, and at this moment in time in the markets, when the markets are down, perhaps really take a view and say, okay, can we realize some losses, or can we realize some gains at a lower value?
Or is now an opportunity to get in? And start
yeah.
something and put a lump sum in and just leave it, and buy at a reduced price.
And exactly that. With the markets down, is it worth taking advantage of that? So I think, in a summary, it's not about the detail. It's about the actionable advice, supporting your clients to move forward towards whatever their outcomes are.
Yeah.
So, what do you have for us, Paul? Do you have any nice quotes today?
There's never any nice quotes about tax, is there? When we did a tax episode quite a while ago, it was in the first series, we included the classic Benjamin Franklin quote, nothing is certain except death and taxes. But I have got a couple of new ones. This one's from John Maynard Keynes, obviously the economist. The avoidance of taxes is the only intellectual pursuit that carries any reward.
I have the same quote. This is how much.
Did you really?
Yeah, I did. That was my first quote. But okay, I like that a lot. I really like that quote. Hence why I put it down. Okay, so I have a quote. I'm going to jump in just in case you got both of them.
Go on.
A fine is a tax for doing something wrong. A tax is a fine for doing something right.
Okay, but like definitely. That. Very good.
That was anonymous. It wasn't me. It was anonymous. But yeah, I like that one. But they were my two favorite. Do you have another quote, or was that your quotes for today?
I got another quote. There's one that's a Chinese proverb, and we include this in our Trails brochure, actually. And it's to do with regular contributions, compound growth, and growing your wealth. And then it goes like this. The best time to plant a tree was 20 years ago. The second best time is now.
Today.
And I'm interested in this because I'm actually looking to plant 3 trees in the back of my garden. Hopefully there'll be money trees. But they're trying to block out one of the neighbours viewing our back field. So we're going to buy some ready-made or half-grown trees, which will probably be quite expensive.
Get eucalyptus. I love the smell of eucalyptus trees.
Oh, yeah? Okay.
Yeah,
I'll have to have a look
nice.
at that.
Really,
looking
really
for cheap trees, to be honest. They grow really fast.
But yeah, anything else, Paul?
I think that's a wrap for this month. I think if anybody has got any tax questions or end of tax year questions, feel free to sort of either DM us or leave some comments in on YouTube, because that's where we generally look. And yes, I would encourage everyone to make use of these, because tax avoidance is allowable, tax evasion, that's illegal, so don't do that. But it's one of these things that you can. It's amazing how much you can save, if you like. Not just by putting money away, but by getting your tax position correct. So take advice and take action.
Super. Brilliant. Okay, well, look, that's a wrap for today. Thanks for joining us. Like Paul said, please like and share our show, and please DM us with any questions. And until next time, be careful.
Thank you. Bye now.
Thanks for tuning in to the Finance Geeks. Don't forget to like, subscribe, and leave us a 5-star review. Drop your comments and questions on YouTube, and be sure to follow us on social media. Join us next time for more insights to boost your financial planning game.